welcome, Quantum AI investors, to another episode. So today I'd like to focus a little bit on the macro, a little bit more, and then the micro. So a couple of things that um, that we're noticing in the economy right now is a weak consumer. There's been conflicting reports about that. In the short run, the manufacturing PMI, we see the manufacturing PMI had a small bounce. So, and they're conflicting, conflicting news reports. So basically, even though we're seeing companies like Kohl's, Walgreens, etc., struggle, and in some cases, some companies go bankrupt, like Big Lots and Joann. We're seeing kind of a bifurcated market where the high end continues to be desirable to some degree, and the low end is just getting crushed. And to that end, if we look at, for example, Walmart, which is usually a bellwether, and we look at this chart, we see this is a pretty bearish looking chart. At least in the short run, it might have a small bounce, but we see gaps below here, 62 and 69 is gaps below. Filled this little gap here, 85. But I would not be surprised if this thing continued to trade down. These big guys are in trouble. Same thing with dollar stores. All the dollar stores are in trouble. We're seeing Dave and Buster's under pressure. We're seeing Wing under pressure, Wingstop under pressure. So there's widespread pressure on the market right now. Target, of course, is under pressure. They've had multiple Bud Light moments, much like Tesla. So sold my shares a long time ago. I've just been watching this one. And Tesla too has its Bud Light moment. So I think that, could this Tesla stock trade down to 150? Absolutely a possibility. So yeah, I mean, in some sense, people look at the SOM rule, real time SOM rule, going from macro, and people will point to this and say there's 0.5, so therefore we're going to have a recession immediately. It's because every time it's 0.5, then we get a recession that immediately follows. Well, yes, that's true. A recession does follow, but the timeline of that is now a little bit in question because of this pullback in the SOM rule. So seems like there's a temporary, I'll bet a temporary reprieve in the SOM rule, which ultimately would delay a recession such as 08-09 or in the 2000 tech bubble recession. It's no doubt that we'll have some kind of recession, and in each recession, at least in the past 20 years, we saw there was some excess in the market. In this case, it was housing, primarily in banks. In this case, it was a tech bubble. And what the recession did essentially is, quote unquote, cure that bubble. So what is the bubble here, right? Arguably, there's bubble in AI, there's bubble in NVIDIA, in Meta, and these other stocks. Why is NVIDIA worth $2 trillion, et cetera, right? So there are, a number of bubbles that are forming in the market. So eventually, we're going to have some kind of event that's going to look like perhaps a tech crash or 08-09. In multiple markets, everything is connected. So when we see, for example, Bitcoin trade down, consumer confidence is also going down. That's because people have a lot of money. Their money is tied up in these Bitcoins. So if Bitcoin crashes, you'll see consumers pull back even further. It's called the negative wealth effect. So that's kind of what we're seeing overall in the market, is this a little bit of the negative wealth effect take hold, but it hasn't really taken full steam ahead yet. So we're still seeing some negative wealth effect that is, I would say moderate. So you want to see the negative wealth effect pick up, and that would probably cause a bout of deflation in the market. So real-time SOM rule, yes, it is one indicator. Of course, we always love to use multiple measures in our indicators and try to combine these indicators to get a better outlook of when this recession might occur. But for now, it looks like that recession at least is delayed a little bit, at least. Okay. So if we look at unemployment, uh, Fred data, let's look at that. We're seeing a couple of things happen. This follows the SOM rule too. Is that the unemployment ticked down? Of course, we know that these are all fudged numbers. If we look at the partial employment, part-time employed, we're at all-time highs in partial employed, and full-time employed is trickling lower, which is kind of indicating a weakness overall in the economy, which I would expect the Fed to start cutting rates soon, and because they know that there's this weakness in the underlying economy, and therefore, usually when you have these uninversion of the yield curve, maybe not the first uninversion, it might take a couple of times for the uninversion of the yield curve to happen, then we'll have a recession. But here it looks like we're just ticking a little higher. We have a little reprieve here, but we're still in this uptrend. So it's something to watch, and definitely in the 2025, 2026, as Doge kicks in and companies close shop, and Joann, Big Lots, all those big stores, retail shops close. I can't imagine this going down a lot further. Unemployment rate, I think we're going to slowly tick higher as time goes on. So until maybe perhaps there's some event that happens and we see unemployment explode higher, right? So, and yes, Walmart and these companies are usually bellwethers for that type of environment, but even them, they'll probably get hit with some volatility because they're trading at sky high multiples. Just from a valuation standpoint, if we go to Walmart, for example, we're seeing right now that Walmart is trading at a P ratio of 35, which is historically extremely expensive for this stock. And I know Jim Cramer's favorite is Costco. It's trading at 52 PE ratio. I can recall multiple times in the past where a 20 PE ratio was normal buying for Costco. So I do expect a bigger pullback. I know like Jim Cramer was buying every pullback, and he's buying over here and whatever. I do anticipate a bigger pullback in Costco as well, for the same reasons I expect a pullback in Walmart. The consumer's weak, is getting weaker. Job growth is stagnant, if not negative, real job growth for full-time jobs, and people are picking up gig work just to make ends meet, which is not really sustainable. So I expect this to come back to the PE of 20. So mean reversion, which would basically mean a roughly 50% haircut from here, which would mean they'd be probably trading in this range, the 400 range. And at that point, it would be probably a pretty great buy. So yeah, we had this enormous run up, and it's definitely overheated. So that's my view a little bit of macro, but also it's coming into some of these stocks that we are seeing. It's like, for example, you'll see Foot Locker has gotten slammed. I mean, you can go down the list here. Wingstop is down 50% recently. Um, you could just keep on going. There's just so many of these stocks that have been slammed. Cracker Barrel is another one. CBRL is another stock that's been slammed recently. Yeah, it's all pretty much due to the weak consumer. Tesla, you could argue, is twofold. One is due to the weak consumer, but also they're having their Bud Light moment with politicization of what's going on, where people are just dumping their Teslas at any price onto the open market. Hurts and just consumers in general that don't like the Elon's political antics, are just dumping these EVs on the open market. So it's not going to spell a very good picture for Tesla, at least in the short term. So I think it's going to come under further pressure. Where I've been seeing value, on the other hand, just from more of a macro standpoint, um, I've been seeing some value in some of these stocks, although I'm not ready to buy them. This one in particular is Louis Vuitton. Louis Vuitton is kind of a bellwether in the luxury space. It's pretty well diversified in terms of what their portfolio has, but we see it has a pretty significant gap here at 100 ish. I do expect this gap to get filled at some point. But there are some values here. So I'm seeing some value in Porsche stock. There's some relative strength here, possibly a cross coming with Porsche. So these kind of international stocks have been forgotten about, like Nestle. I bought it down here when it was kind of in the doldrums in 80, and I couldn't resist, and now it's 103. So multiple gaps downward. I do expect that even though we broke above this, there'll be some sell off here in Nestle. Um, kind of in sympathy, probably with Walmart sell-offs coming, and Costco and etc. But yes, all that basically means that there's going to be an overall sell-off. I'm not predicting a bear market, but I'm predicting definitely some kind of weakness in the market as we see this. For example, Nvidia with a 50 crosses the 200. That's usually a bearish sign. So I would expect this to come down a little further. We're seeing lower lows being formed and lower highs, which is bearish. We see the 50 and the 200 bearish. There's really not a lot to like at NVIDIA at these valuations. If it comes back down here to support a 50, I think it'll be much more palatable, much more likable. And that would probably be in sympathy with a Bitcoin crash too, to about the same level. I'm not saying it's going to happen overnight. It's probably going to be noisy. So it'll be like some some rips and some dips. So rip and dip, rip and dip, rip and dip. So it's going to be very hard to directly short this. That's my opinion. So better off not shorting and just watching from the sidelines. But yes, international stocks is where it's at. If you're into international stocks, some of those names I mentioned are worth investigating, and names like them are always worth investigating. I think there's one other that is popular is Nintendo. Now Nintendo, they do have a gap here at 13. Um, Kind of had a short-term blow off top here, but it formed another gap. They are coming out with a Switch 2 this year, so I do anticipate that would be probably a nice little jump for them. But consumers under pressure. I do see a little bit of this cross going on right here, potentially bearish in the short run. Perhaps we retest 15 here on Nintendo. But overall, I mean, stock is pretty bullish, and Nintendo has a pretty solid foothold in their market. So stocks that are similar to this, international value stocks that have been really forgotten about are the types of stocks that one should think about investing in long term. But yeah, a lot of the stocks got rocked. SMH, I said this, sell that yesterday. In fact, in my video, I took profits and just watching from the sideline now, see what happens. Um, and yeah, so that's pretty much it. We got a couple of macro factors, but the macro factors you could see is kind of exposing itself in certain stocks across the market, and it's very spotty. It's not a very evenly distributed sell off. So if you look at how concentrated this market is with, for example, Nasdaq, and it's all basically the Mag 7. So if the Mag 7 gets hurt, we'll see Nasdaq drop like a stone. I know that they're definitely, like, Chris Van Mullen is a bomb bull, and there are David Lynn, and these others might be bullish on bonds, and hey, that's very true, but it's very hard to trade them. So I would recommend, if you're into it, and again, this is take everything here with a grain of salt. I would recommend that things like TLT, for example, are just long-term buys. So like you would just buy the TLT and wake up in 3 years and look at your account, and that's it. Like, because TLT, um, yes, people do trade TLT, but I just view it as a kind of a sleeper. It's a sleeping giant is what it is, because as soon as they start to really cut those rates hard, it's been in this basing pattern for some time. You'll see this TLT fly up and perhaps retest here, which is 132, which is a huge move. But I anticipate, like Nvidia going down, rips and dips. So it's going to be very hard to trade this unless there's something that would tell you, like a bull flag or a bear flag or some other pattern that you can notice in here, that would be tradable. So I would say, with TLT and things like TLT, it's kind of just like you buy and you hold it at this level, and you just wait for the Fed to cut the rates, because that they will. It's just a matter of time. It's just a matter of how rapid they will cut it. Every time they've cut their rates, it's been followed by recession. Now, not right away, but within a certain time frame, right? So whether it be a year or 2 years, there's some recession there. There's always noise in these things. So if you use too much of a pattern of trading where you're just trading the noise, that's probably not going to make you a lot of money, because noise is hard. It's hard to predict unless you have a solid pattern, right? So if you have like a bull flag pattern, or like I said, another pattern, a bat pattern or something, if you can trade that, that's okay. But if there's no real pattern emerging, here we just have basing pattern. It's kind of just like buy and then just sleep at night knowing that TLT will be around this price, because one day it'll wake up and you'll look at your account and it'll be much higher, but and the market will be lower. So that's kind of, it's acting like almost like an inverse ETF in a way, at this point, because it's just so oversold, the TLT, that anything could make this, any risk off event could make this literally skyrocket. So that's all for today. I hope you did enjoy this. I'm posting a little late today, so I hope you enjoyed this, and like, subscribe, comment, and if you would like to see anything else, I'd be happy to show you guys. I'm happy to do more macro view stuff or comments on, others in this space. So take care for now.